Good morning, everyone. Let me start by saying that I do not get shocked and surprised easily. Having been around this business for a couple of decades, I tend to think I've seen it all, but there are some things where I do get surprised. My name is Andy Norton. I am with Sampson Properties, and I am here with Mary Krieger of Movement Mortgage, who can be contacted, as you can see, at the number above. And Mary is among different areas of expertise on first-time homebuyer programs with the Virginia Housing and Development Authority, VHDA. And in a moment, we're going to dive into the details. But there's one thing that really surprises me on this particular program. And we were talking off camera. People think, okay, yes, this is for a first-time homebuyer. And if you're watching in the audience, a fair question would be, well, isn't a first-time homebuyer somebody buying a home for the first time? Well, it's a government program, so why don't you tell people what a first-time homebuyer actually is?
Okay, so some banks and credit unions might have a different, or what you might understand as the layman term of truly buying your first home. But the definition here for the programs we're going to be speaking about, a first-time home buyer is one that has not owned and occupied a home as their primary residence in the past 3 years. So that time frame is key. You might be renting today and you owned a home 5 years ago and moved from Idaho. You would be considered a first-time home buyer. Another example that might shock people is a gentleman I'm working with today vacated his marital residence due to divorce 5 years ago, and ex-spouse, sold the home 2.5 years ago. But because he didn't occupy that home, even though he was still on the deed as owner, he did not occupy that home as a primary residence in the past 3 years. Therefore, he meets the first-time home buyer definition.
Okay, and similarly, if somebody watching has an adult child who's living in the basement, they are not a homeowner, so they would be, in terms of occupancy anyway, eligible.
Correct.
Okay.
Yes.
So there are 3 broad categories of benefits on the VHDA. And if anybody is thinking, oh, it's a government program, this must be a snoozer, not really. You're going to be as surprised as I am. Let's talk first, if we can, about down payment assistance, because it's really quite generous. So tell us about the down payment assistance.
Sure. So most of the, Virginia Housing offers conventional FHA, VA, USDA programs, just like the standard government programs that any lender or bank might offer. But under the Virginia Housing umbrella comes with it bells and whistles of a lot of opportunity of potentially free money, grants, and savings that basically you don't have to pay back. So with the down payment assistance, a conventional loan typically has 3% down payment requirement at a minimum, and an FHA loan is 3.5%. So the grant is 2% or 2.5% on either of those programs, and 1% from the buyer. So the 1% is the minimum buyer contribution, 2% conventional grant, 2.5% FHA grant. Essentially, you don't have to pay it back. And there's no minimum occupancy of paying back. If for some reason you have to relocate in a year, that money was forgiven after closing, the day of closing. Now there's a closing cost assistant grant similar to this because VA and USDA are 100% financing. There's no down payment requirement. So VHDA, Virginia Housing, offers 1 or 2% grant for those programs to be coupled with to contribute to your closing costs. That allows you to even make a better offer by not having to ask the seller for potential closing cost assistance. So in all of those cases, I'm going to give you an example of on a conventional loan, let's say a $600,000 purchase price, 2% of that is $12,000 and a grant, which is essentially free money. On an FHA loan, 2.5% is $15,000. So we're going to be adding up here at the end, but based on the 3 buckets that we're going to be talking about, keeping track of these dollars that is money in your pocket.
And many people think that housing assistance may be something that has to be paid back. But you're talking about a grant, and a grant is a grant. It really is, from the day of closing forward, free money for the buyer to help them buy.
Correct. Now, with the eligibility, not only being first-time home buyer, the grant does have a different income bracket. Now, one of the things for a two-person household, for instance, $129,600 is a one or two person household income limit to be a recipient of the grant. Otherwise, Virginia Housing standard income is $162,000 for a two-person household. That's a single person, that's a newly married couple or two individuals, or maybe a single person and their elderly parent. But the three or more person household to be eligible for the grant is $151,200, and then their standard VHDA income limit is $189,000 for the household income. So that's one of the things, as we're talking about the various programs, the income limits have to be met first and foremost. And then the first-time homebuyer status, typically, some of the Virginia housing programs don't require the first-time homebuyer status. They could be repeat buyers. But in the cases that we're talking about today, specifically for first-time homebuyers, the grant does have 80% of the standard qualifying income as one of their requirements. Knowing the guidelines up front, $151,200, is the cutoff for the three-person household, and $129,800 for the two-person or less.
Right. So that if anyone's thinking that this is necessarily a, quote, low-income program, if you have three people who are buying this together at $189,000 per year combined income, by anybody's imagination, that's not low income.
It's not. But, technically, when you look at the cost of living in this area and our income limits, we are talking about the Northern Virginia, Washington metropolitan area. The income and sales price loan limits does go down. Richmond, Charlottesville, so other areas are certainly not going to be this high. So we do get the benefit of where we live today. And we will mention, too, that towards the end of last year, Virginia Housing increased the loan limit and sales price to $665,000. So again, that's not your normal everyday first-time homebuyer, house price. But in this area, again, it makes it affordable for those that do have that opportunity in that income bracket, and to be able to afford, taking advantage of a $600,000 home with the free money that could be available to them adds up, certainly.
So that really, under this program, technically, somebody could purchase a home for $250,000 for four walls and a roof, and it qualifies. Mm-hmm. Okay.
So that's the key thing of qualifying. Get your application in and let's talk, because
that's right.
Just because you make that much money doesn't mean you're going to be eligible. We've got to look at the big picture of credit and debt, and run the full application process. So we're just highlighting the benefits, and let's get you in and see if you're eligible.
But that is, I think, an eye-poppingly large number for an assistance program.
Absolutely.
Okay, a couple of other really interesting things about VHDA. Can you talk a little bit about the tax credit? Because in addition to free money on a grant that you spoke about, there's also a potential tax credit that the buyer is going to get. That's amazing.
It is. And, this mortgage credit certificate from Virginia Housing could save you thousands of dollars by reducing the amount of the federal income tax you owe each year. And what's really neat about this is that you can get an MCC with a non-Virginia Housing First mortgage. Okay, so that means if you are eligible, first-time home buyer, and meet the Virginia housing income limits, you could buy this MCC for a one-time $1,000 fee at closing, and you get that for the life of the loan. Now, if you're doing a Virginia Housing First mortgage, it's free. So essentially, what happens here is, and we want you certainly to talk with a tax advisor for personalized information to see if the MCC is right for you, but we want to give you the highlights to understand what the dollar value could be. So the MCC is equal to 10% of the annual interest that you pay in any given year. And it's certainly as you pay your mortgage down, you're paying principal and interest, and you're paying a lot more interest up front in the early years. But that amount goes down as your principal balance goes down. So that dollar amount of the dollar for dollar tax credit will go down year after year. But like I mentioned, it is good for the life of the loan. If you refinance, you lose the MCC. If you sell the home, you lose the MCC. If you vacate and no longer live in the home as an owner-occupant, you would lose the MCC, the tax credit. But yes.
Okay. So, and again, this is a credit, not a deduction.
Correct.
Okay. So in a hypothetical situation here, with hypothetical taxpayer, and they go to their tax professional and they get the blessing of the tax professional, because it's a credit. If they had a total federal tax obligation of, let's say, $3,000, and if the credit was approximately $3,000, then in this example, they could essentially take their tax burden to zero.
Exactly. That's the key thing, is you do have to have the tax liability for it to kick in. Now, if you can't use the tax credit the first year, it rolls over and is good for up to 3 years. So that's when you really want to take advantage of working with the tax advisor to figure out how to make that work for you. Now, it's also the 10% of the annual interest is the dollar for dollar tax credit. The other 90% you can use as a deduction, a Schedule A deduction. Again, depending on what fits your needs and how you do your taxes and taking the benefits that you can, you can choose to use it that way. You can take the 10% and not use the 90% on the Schedule A. So just to use the numbers, given our $600,000 purchase price, a conventional loan, 3% down, is $582,000. Now, at a 6.25% interest rate, that first year, assuming 12 months, is $3,638. On an FHA loan, 3.5% down, $579,000 is our loan amount. And at a 5.75% interest rate, that tax credit would be $3,310. Again, if you're buying in the middle of the year, you're only going to have 6 months potentially left of whatever that interest is. That might be the year you roll over and wait until you're doing your taxes and can plan accordingly to create the tax liability for you to take advantage of this. You're not going to get a check from Uncle Sam for that dollar amount. It has to offset and be used to pay a tax liability. Again, the requirements of a first-time home buyer, the home is your primary residence, and you meet the standard, the higher Virginia housing. But a key is you can use this on a non-Virginia housing first mortgage.
Okay, so we've covered down payment assistance and the tax credit. And at the risk of this sounding like a commercial in the middle of the night, but wait, there's more.
There's more.
There's more.
Yes.
And there's more. There are a lot of people watching this who will say, yeah, I should have bought last year because interest rates were lower and interest rates are too high. But the third feature of what I'll call the trifecta of the VHDA program of assistance, the third element of this trifecta is interest rate reduction. So if you're out there thinking, oh my God, the rates are too high, if you can tell us about the interest rate reduction as well, on top of the other things.
This one is definitely like winning the lottery. The fiscal year 2023 monies have been allocated for the Sponsoring, Partnership, and Revitalizing Communities, also known as the SPARC, S-P-A-R-C, the SPARC funds. This program provides below market rate for first mortgage using the Virginia Housing First Mortgage programs. It is essentially a 1% rate reduction from, if it's a 7% standard for everybody, 6%. Now, this is what's really key because it's first come, first serve. The allocation, once it's gone, we never know if it's going to be back. And right now, every county has different rules. So it is so important to really work with folks that are ingrained in these programs to understand and know the nuances. Loudoun County's income limits are different than Fairfax County. Loudoun County requires you to currently live in Loudoun County if you're going to be buying in Loudoun County and expect to get the Spark 1% rate reduction. Fairfax has a different, again, makeup of their household incomes, but it doesn't require that you currently live in Fairfax County. So you have the opportunity to reduce your rate by 1%. So as we're adding up the dollar of savings here, given our scenarios and what it would normally cost to buy the rate down, on a conventional loan, currently 7.25% is the estimated VHDA rate. Buying that down to 6.25% would cost 1.5% discount points. So on any given day, you're given a lot of rate variations. You can buy your rate down or get a par rate that costs you nothing, but you can pay to buy your rate down or get a higher rate and we'll give you a lender credit to offset that. So on the scenario for a conventional loan, buying the rate down would be $8,730 of what that cost would have been. On the FHA scenario, taking the rate from a 6.75 to a 5.75, that would be $8,685, what one would have to pay to buy that rate down if they were not eligible for the Spark funds. So the grand total of these three buckets of savings is approximately $24,000 for a conventional loan and $27,000 for an FHA loan. But it's most important to understand this last rate reduction piece is, again, not for everyone, not available in every county, and it may be gone by the time you're ready to start.
But if it's available in the county that they're in and the funds are still there, and if the borrower is qualifying in these various different categories, it's not a question of the down payment assistance or the tax credit or the interest rate reduction. In theory, they could qualify for all three.
In theory, absolutely. You
Okay.
can qualify for all three, or just one, however it works out with the eligibility.
Okay. So as a buyer, if you're on the sidelines, or if maybe one of your adult children or grandchildren is on the sidelines thinking, we need to wait, we may have missed the boat, this is a fabulous program. You can contact Mary at the 703-597-6279 phone number. Thank you everyone for joining us, and contact Mary about the VHDA program. Thank you.